Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 2nd, 2024. Yesterday I covered this. I just want to mention it, was the rate of unemployment is going up. It's certainly going up in the tech industry because of layoffs. It's going on in other industries, and people fear they're either losing their jobs or they fear losing their jobs, which is slowing down spending, which is causing corporate earnings to decline, which is causing the stock market and the economy to decline. And then it's a vicious cycle that keeps on going. That's where we are today economically. Okay, I'm going to cover the dashboards to show you what's going on this past week, and basically a positive report for the past week. We had, in the yellow box, we have last week's results, so you can see of the different indexes, the Dow, S&P, NASDAQ 100, Russell 2000 small cap index, emerging markets and developed markets. You can see that most of them were positive, shown by the green color, and two of them were negative. And then one was negative. The last one is not the equity market, it is the bond market. So the bond market continued to decline a little bit, slightly, and you can see that as minus 0.31. And then in the pink box are the year-to-date numbers for the equity markets, those same markets, starting with the S&P, NASDAQ 100, etc., going in descending order. To the right of that, you can see the green dots or red dot. The green dots indicating that those in particular indexes are above or below their moving average. Green indicates above, red below. So 1 out of 28, which is in the bond market, 1 out of 28 is negative. So it has basically been a positive equity market and even a somewhat positive bond market. As we take the S&P and break it down into its component parts, you can see that in the center, the weekly number is, some are negative, some are positive, kind of a mixed picture. And then you can see to the right of that, the year-to-date numbers for each of the sectors, starting with financials, industrials, technology, consumer staples, etc. To the right of that are the four moving averages, the 20, 50, 100, and 200-day moving averages, and where each of these sectors is relative to those moving averages. So by and large, positive during this past week because some were negative. It caused some of them to drop below their 20-period moving average, and the energy sector at the very bottom is below all four of its moving averages. This is a 24-month weekly chart, meaning that one move in this chart equals 1 week and spread over a 24-month period of time. I drew a black arrow showing from lower left to upper right the direction of the S&P 500 for the last 24 months. So if you said in the last couple of years, is the market negative or positive, or even for the last year, you would say definitely the market is positive and moving in an upward direction. We don't know the future, but I put a 20-period moving average on there underneath it so you could see how it is relative to that 20-period moving average. Then I took that same period of time, 24 months, and put it onto a candlestick chart. And if it's kind of a hollow candlestick, that shows it starts low and finishes high. And if it's a red candlestick, it's the reverse of that, starts high and finishes low. But you can see most of the weeks are positive. They start low in the week, and then they move on up from there. And at the very end of it, the very upper right, you can see the little short candlestick at the end, and that was last week, showing that the market did move up, but it moved up slightly, using the S&P 500 as a proxy for the market. This is a relative strength chart. So this shows the NASDAQ 100 relative to the S&P 500, the broad market. So on a numerator-denominator basis. So if it moves up, this favors NASDAQ 100, and if it moves down, it favors the S&P 500, the broad market. And in that period of time, 24 months again, you can see that generally speaking, the S&P 500, you can see that the NASDAQ 100 has outperformed the broad market, the S&P 500. When we take the S&P 500, and again, one more time, break it apart into growth stocks and value stocks. These are represented by the ETFs SPY-G and SPY-V. If it goes up, it favors growth, SPY-G, and if it goes down, it favors value, SPY-V. And in this period of time, it's gone up and down a lot, but generally speaking, since the beginning, it has moved in an upward direction, favoring growth. Again, relative strength chart showing SPY, S&P 500, relative to the small cap index, so IWM, the Russell 2000 small cap. So same thing, moving in an upward direction, favoring large cap SPY over IWM small cap. Long-term government bonds, this is not a relative strength chart. This is just the bond index itself for the ETF TLT. And you can see since October of last year, so this is about a year. In this year, I put an arrow at the end of it. It's a 5-year chart, so it's showing during the last year, the bond ETF TLT has generally moved up from its bottom in October of last year. The dollar, I'm just looking at the last quarter or so, the dollar has been moving down. It was moving up for quite a period and now is showing weakness and pulling back. The winner really for this year, or for this week, this week is gold. Gold and silver actually both moving up. They're trending up and they're moving up for the week, probably more than most assets. And you can see where it's going. There have been periods where gold and silver in particular have struggled, but now they seem to be moving positive. This is a defensive indicator because when people fear the economy or equities or the dollar, where do they go? They typically go to precious metals. So in a way, this is not surprising. Silver, more volatile than gold. So gold had this trend of going up. Silver bounces a lot. But still, generally speaking, I'm just comparing it to last October, generally speaking, it's moving in an upward direction. And you can see the move up in the last couple of weeks at the very far right of the chart. Bitcoin continued to have a positive week and is moving up from where it was about a month ago. The volatility index, indicating market volatility, when this goes down, it favors equities. When it moves up, it's more not favoring equities. So I put a red line at 24, which is my opinion of where a risk starts to come into play when it moves up through 24. We're not there yet. I mean, we're right now at 16, which is fairly low. So that's basically positive for equities, even though at the end of it, it ticked up some. I think this is the third week in a row that the Asbury Research, Asbury 6 indicators have been 5 positive and 1 negative. So with 5 positive, that is a positive indicator for the market. And they may shift around a little bit, but 5 out of 6 is positive. Cross-asset relative performance. This is where Asbury compares certain assets to other assets. For example, stocks compared to bonds. Stocks are more favored, and you see to the far right in the last week, the last month, the last quarter. High beta high volatility is more favorable than low volatility for the same 3 time periods. developed markets are more favorable than the U.S. markets. So that would mean like Europe and Japan being more favorable than the U.S. market. Emerging markets are more favorable than the U.S. market, and you can imagine, certain countries in Africa, and of course the BRICS nations, Brazil, India, Russia, China, and South Africa, all definitely bellwethers for and proxy for the emerging market segment. This is a chart that's been, it just continues to be dynamic, showing where money is moving into one country versus another. This features the U.S. relative to 21 different countries or regions. So the ones that are more favorable than the U.S. for all three time periods are Chile, Peru, Italy, Germany, Spain, France, the entire Eurozone, Malaysia, Hong Kong, Taiwan, India, China, even Thailand, Australia, and the emerging market segment. The U.S. is stronger than Mexico, Japan. That's it. I'm looking at all three time periods. Those that are fractional, I don't mention them. I'm still using South Korea as a proxy for U.S. strength. Now, at the very far right of the chart, you can see that it came down this past week. A number of them did, but still, relative to its 20-period moving average and over a long period of time, or intermediate period of time, you can see that the U.S. has done stronger than South Korea more consistently. So that may break down and South Korea may take off, just like Thailand did, but we don't know that yet. Gold and silver. Gold, the spot price is $26.59 as of last Friday, September 27th, up, as you saw in the chart, 1.4% from the previous week. Silver, the spot price is $31.62, up again 1.4% from the previous week. The gold-silver ratio is retained at 84-1. A monster box of silver, which is, serious investors tend to buy monster boxes. You could buy less. You can buy a few ounces of silver or a tube. You can do all of that. But a lot of people buy it in monster boxes. The monster box, as of last Friday, was $16,470, and that includes the markup, which, as of last Friday, was $1.32. This brings the price per round on generic silver up to $32.94 per ounce. The information is courtesy of my son, Preston. There's a light side and there's a dark side, and then there's the Fed. I'll leave it at that. Thank you for watching. If you have questions or comments, leave them in the comment section below.